Today, we're going to crack open the black box of life insurance. We're going to figure out exactly what you're paying for and why.
So you get a life insurance quote, right? And there's a number. But have you ever stopped to think, wait, where did they get this number from? It can feel totally random, kind of like they pulled it out of a hat. But trust me, it's anything but.
You see, it's so much more than just how old you are. It's a super detailed risk assessment. So what we're going to do is follow an application from start to finish. We'll see exactly how all those numbers get crunched. It really all boils down to one thing: figuring out your personal risk score. And there's an official industry term for this whole process. It's called underwriting. Honestly, you can think of it as the insurance company playing detective. They're gathering all these clues about your health and your life to figure out how much of a risk it is to insure you. So after all that detective work, you'll get sorted into one of these three main buckets. Preferred is the top tier, low risk, and you get the best prices. Standard is, well, for the average person with average risk. And then there's rated. This is for folks who are considered higher risk, and that of course means a higher price. Okay, so what clues are they actually looking for? What goes into that risk score? Let's break down the personal stuff they look at. We all kind of know age is a big deal, right? But you might be shocked at just how much of a big deal it really is. And just look at this chart. This is what's so wild about age. It's not a slow, steady climb. It's an exponential curve. I mean, the difference in cost between your 30s and 40s is one thing, but look at that spike after age 60. The price just skyrockets. It really shows why locking in a rate when you're younger makes such a huge difference.
All right, so the next major factor the underwriters are going to look at is your gender.
This chart lays it out perfectly. We're looking at premiums for a man and a woman in the exact same risk class. See how the blue line is always lower? It's purely statistical. On average, women live longer, which makes them a lower risk for the insurance company at pretty much every age.
Now, this is a really important point. The insurance industry is still figuring things out when it comes to transgender and non-binary applicants. The historical data just isn't there yet, so different companies do different things. Some might use your preferred gender, others might go by official documents, and some are even starting to use blended or unisex rates. It's a space that's definitely evolving.
Okay, beyond your age and gender, your health is probably the single biggest piece of the puzzle. We're talking about your overall health, and, maybe most importantly, whether or not you smoke.
And oh boy, does it make a difference. Just look at the massive gap between Class 1, that's the best non-smoker group, and Class 5, the worst smoker group. At every single age, the premium for a smoker is just way, way higher. It shows you that smoking is probably the most expensive habit you can have when you're applying for life insurance.
But wait, it's not all about you. The price you pay is also affected by what's going on inside the insurance company itself. Let's pull back the curtain for a second.
So there are really three big things going on here. First, there are mortality costs. That's the money they expect to pay out to other families. Second, admin costs, keeping the lights on, paying salaries. And third, and this is a big one, how well their investments are doing. If they have a bad year in the market, they might have to charge more for new policies to make up for it.
Have you ever wondered how a company can even afford to write, say, a $15 million policy? They don't just take on all that risk themselves. They use something called reinsurance. Basically, they buy their own insurance policy from an even bigger company to offload some of that massive risk. It protects them from a huge potential payout. Now, policies aren't always a simple yes or no. Sometimes there's some fine print involved, or things can change over time.
Here's a perfect real-world example. Michael was super healthy, but he travels regularly to a place the insurer considers a bit risky. So instead of just saying no, they offered him a policy with what's called an exclusion. It just means his coverage is fully in place unless his death is a direct result of that specific activity, in his case, traveling to Lebanon.
Now check out Bill's story. He started out as a commercial fisherman, which is a really dangerous job. So his policy was rated, and he paid a ton for it. But years later, he switched to a much safer job. And this is where things get interesting.
See, the whole reason he was considered high risk is gone now. So Bill can actually go back to the insurance company and ask them to take another look. And if they do, they can remove that rating and lower his premium. So the big takeaway here is that a high-risk rating isn't always a life sentence if your situation improves.
Okay, last up, it's really important to know that this super intense individual deep dive we've been talking about, it doesn't happen with every single type of life insurance.
Think about the life insurance you get through your job. That's usually a group plan.
The insurance company isn't digging into your personal medical records. Instead, they're looking at the average risk of everyone in the company, the whole group, to come up with a rate. It's about the collective, not you as an individual.
Okay, this is a really important one to understand, so listen up. It's called post-claim underwriting. You see it sometimes with creditor insurance. You know, the kind your bank offers when you get a mortgage. They ask you like 2 questions and boom, you're covered. The catch? The real investigation, the deep dive underwriting, doesn't happen until after you've passed away and your family files a claim. And if they find anything then that they don't like, they can deny the whole thing. It's a huge risk.
And that all brings us to the final and most important question. After all the forms, all the underwriting, all the payments, is the protection you're paying for actually guaranteed to be there when it's needed most? Knowing how this all works is really the first step to making sure that answer is a confident yes.